But Mindtree has posted a stable Q4 with the dollar revenue at close to $195 million. The company did guide for a low double-digit revenue growth in FY18. What does this mean for the IT major? To give us an analyst view, joining us on the show is Rahul Jain, Vice President for Research at Systematix Shares and Stocks. Rahul, thank you for being with us on the show. Let's start with the revenue growth itself, 2% on a constant currency basis sequentially, but the profit is much lower than expectations thanks to that forex hit that the company has undertaken, I suppose, of 22.8 crores. So take us through the headline numbers first. How does it fit in with what you were working with? Then we'll go into the other modalities.
So yes, if you see the operating result, it has been a little better than the expectation. 2% constant currency growth on the top line, 60 bips, 70 bips improvement in the operating profit. So on the operating front, it was better, little better than the estimate. Only thing, because of the forex swing of favorable 3 odd crore to 22 odd crore negative has made the profit number look little lower than what the street was building into it. So otherwise, operating wise, I would say the results were better.
Right. What are the problem areas, Rahul? I mean, we've seen some kind of a recovery that is playing through in terms of the operational performance now, as opposed to what we had seen 3 or 4 quarters back. But to what extent do you think this is sustainable? Because in terms of the top client, I mean, the top 10 client revenue, there is some kind of pressure from there also as of this point. So take us through that, because the top 10 client revenue as a percentage has gone down in this quarter sequentially to 41.9% from 42.3%.
So yes, they had this two kind of problem. One is that 2 of their top 10 client is what saw some problem in last fiscal, and they saw 2 client from 11 to 30 kind of a bucket who has now scaled up to the top 10 category. So yes, the growth on the top 10 has been little bit challenging, but their commentary post 4 quarters suggests that some of these things are addressed to a certain extent based upon the survey they have done and their own offering versus what the client is demanding. So that is matching up. That is point A. On the other thing, why the profitability has been weak, I think it has to do much with the 2 acquisition, Magnet 360 and Bluefin, especially Bluefin, where they saw traction going down on the growth front as well as absolute revenue decline, which led their operating profit going into losses. This quarter they have reported some 3.5% operating margin on the Bluefin business. I think as Bluefin business come closer to its long-term margin or around 10-12%, I think that could be the biggest delta in terms of any margin uptake expectation for FY18. That would be a key determining factor.
Right. Rahul, for Bluefin, I remember the company had issued a guidance in terms of some kind of a profit warning, if you would put it that way, post the Brexit event. So is the overhang on Bluefin completely over for now? Because emanating from that geography, that seems to be some kind of a key risk on the overall operating performance, right?
Yeah, I mean, it's too early to calling it out safe straight away. Given the challenges, yes, it would take its own time for the recovery has to be pretty gradual rather than a quick fix on that. And what they have done in the interim is that they are taking those capabilities into the US market, which is far bigger opportunity. So I think if they recover on the business run rate on the UK side and add some opportunity in the US, so collectively Bluefin subsidiary or business should do better, much better than what they did last year. I think that is the way to look into it going forward, not to expect great from UK, but UK plus US, it should be doing better.
Right. Rahul, if you can take us through the geography-wise performance as well, because as you said, I mean, they're trying to take a greater business opportunity to the United States. Over a 1 year period, the proportion of US revenues, contribution from there to the overall revenue has gone up from 65 odd to almost 70% now. Concomitantly, the European contribution has reduced from 24.6 to 20.8. Sequentially, these have remained mostly stable. So is that the larger strategy? And for a company like Mindtree, with such a lot of US exposure, what kind of margin headwinds do you see in terms of two things? One is the H-1B visa costing from the employee side and thereby the margin, and also the rupee move that seems to be strongly sustainable also.
Yeah, so from a geographic standpoint, I guess it is also a function of how some of these European currencies have moved in the year. So if you see, GBP has depreciated by 20% against the USD, and Europe has also the euro has also declined. So there has been a general shrink in Europe as a market for most of the IT players, just on the like-to-like basis. The constant currency impact is not as big as it is seen in the total revenue line from a geography breakup point of view. So that is point A. From the margin perspective, given their exposure to US, from visa point of view, they are clearly stating that they would rely less on H-1B, and they have in fact indicated a lower outgo on the visa front, what they normally do in 1Q. So they are relying less on that and probably looking to hire more on the local basis. So yes, that may have some impact in terms of local hiring may be a little more expensive than what they could have put it through H-1B. But I think it is very, very important investment to do from a longer term perspective, because the way their on-site business is growing much faster than their offshore business, given the digital being 40% of their revenue. I think it is very critical for them to create employee base out in those respective markets rather than relying much on the H-1B. And I think in general margin pressure, I think it would be combination of both. One, from their own business front and operating leverage front, they would have this advantage of gaining some 200-250 bips just by their business recovery and operating leverage. At the same time, they may have 50-100 bips kind of a challenge given the rupee which it is trading right now. So we have also curtailed our number, building 65 rupee to a dollar for the upcoming period, which has impacted our overall estimate to a certain extent.
On the segment-wise revenue, I mean, BFSI, do you see some kind of recovery? Because overall, it's close to 25% of their mix, and technology and media services as well as a large portion. So these two contributors, and also in terms of the service offering, there's development as well as the infra segment, which are the big value contributors. So if you can give us a split for both these, segment-wise and service offering-wise.
I think more than the broader service offering, the way going forward is how much of the business are driven from digital standpoint, because that has become the core thought process behind the IT budget spend and the CTO CIO decision making process across the corporate. So they've been sharing this data on what is the growth on the digital front, what is the total contribution, and I think that is pretty good. 40% of revenue is probably highest among the companies who are reporting that as a separate number, and they are disclosing the number of when they are doing there, what is the size of the new transaction they are doing, and there is reasonable growth in that deal share as well, which gives a sound visibility. Another important metric which they've been highlighting is the size of the engagement in digital business, which is also improving and is coming closer to $1 million, which I think is a very important barometer, because as this size of the engagement improves in digital, that would be a key driving factor from taking the current run rate of business of around 150-200 million on the digital business to the next level and drive the overall growth for the company.
Right. And Rahul, before we let you go, can you take us through your pecking order from the mid cap as well as the large cap pack?
So among the large cap, we have preference of TCS and HCL as our preferred bet over Infosys and Wipro at this point of time. Among mid cap, we like Emphasis, Oracle Financial as our preferred bet there, and Ramco System among the small caps.
All right, Rahul, we're going to leave it at that, but thank you so much for joining us and dissecting the Mindtree numbers for us, taking us through the stock impact and also your preferences from the large and the mid-cap buckets. Well, let's move on now and put the focus on global issues. The big story as we head into the weekend will be the French elections. Sharing the market's nervousness is none other than IMF chief